How's it going? It's Charles Botensten from Botensten Properties International. As mentioned, I'm going to be doing a video each day. Actually, this shirt is exactly the shirt I had in Boston a couple of days ago. It's a nice sweater. It's getting a little chilly here in New York. It was actually a very mild summer, and obviously that means it's going to be a chilly fall, and in a freezing winter, here comes the snow. But anyway, I'm going to be doing a video each day, each weekday, answering questions. Could be long, could be short, whatever the case is. Today, we are going to be talking about debt to income ratio. The exciting part about debt to income ratio is that I was awful at math. I was going to say I sucked at math, but I was awful at math. And essentially, when it comes down to math and real estate, I use a calculator, which I'm actually looking at one right now. And it's really there for two reasons. One is the mortgage and the other is the debt to income ratio. Let's be honest. What is it? Why is it important? The only reason it's actually important is if you own a bunch of property and for a condo. We'll talk about condos first. The only reason is if you're financing and your debt to income ratio is too high and the mortgage cannot be sold to Fannie and Freddie. So in other words, there's obviously a list of criteria that the banks go with, the big boys, Citi, Chase, Bank of America, Wells Fargo. They use a debt to income ratio that the government has set, and I think it's 42%. Do not quote me. But I think it's 42%. And if your debt to income ratio, which I'll explain what the debt to income ratio is next, if your debt to income ratio is above 42%, then you can't get a mortgage. So that's important in a condo. I'll explain in a co-op why it's important as well. So a debt to income ratio means this is what you do. You take your total income, your total monthly income, and you divide it into, or you put it whatever the actual nomenclature is, whichever divided into, I don't know which one you divide into, but you take your total gross before taxes income, everything, investments, salary, bonus, commissions, whatever the case is, and then you take all of your debt. And this is very important. It is all of your installment debt. It is not your revolving debt. Revolving debt means you get a credit card bill every month, you pay it off. You get a credit card bill and you paid it off. But if the credit card bill is $15,000 and you're paying off $1,000 each month, that's an installment debt. That means that you did not have a zero balance at the beginning of the month and then you have a zero balance at the end of the month, okay? That's revolving debt. You have zero, then you have zero, zero. Each month you pay off your credit card bill in its entirety. If you have an installment debt is student loans, car payments, mortgages. If you had a large purchase, office equipment or a boat or anything that you have just a principal and an interest just sitting there and you just slowly chop away at it, that is installment debt. So that could be anything. So you take your installment debt and you divide that into your gross monthly income and you come up with a percentage. All right, so here we go. Now we're talking about Manhattan condos. Manhattan condos is a little bit different. So Manhattan co-ops are very particular with their debt to income ratio. And this is why usually only Americans buy in co-ops because their debt to income ratio is exactly what they want. So when you have a foreigner coming over, all their assets are overseas. The co-op doesn't like to see that. So they usually only take Americans in co-ops because, say you default, they have no recourse. They can't go overseas to Belgium or England or Brazil or China and get your assets. There's no way, I already said that topic. Or not said that topic, but I already buried that topic. So you're talking about someone that is looking at a co-op that works in the United States, likely New York, because they know how to go through the co-op process, or at least are willing to go through the co-op process. Say someone from California doesn't really like coming through and saying, what's this debt to income ratio? I have to keep it at a certain percentage. So the debt to income ratio ideally is 25%, 26%. In other co-ops, it has to be 20%. So that means, say you make $10,000, your debt to income ratio, or you make $10,000 a month, and your installment and including all of your monthly payments for your current mortgage, say you're getting a mortgage out, and your debt for the month is $5,000. That means you make $10,000, your debt is $5,000. It's 50%. That's not good. You're not getting in anywhere. You need to go to $2,500. So in other words, you make $10,000, you have a monthly debt of $2,500, and I make $10,000, $2,500 is the debt divided into the $10,000. That's 25%. Okay, so that's the easy way to show an example. What numbers do you need? Okay, I mentioned 25% is ideal, 26% is ideal. It has to be below 30%. 29% is really the highest that a lot of these co-ops, listen, there's a lot of co-ops that I put people through at 31%, but they've also made a huge amount of money and they had great credit. So it's not just the debt to income ratio, or they're putting a lot down, or they have a huge amount of assets, something. There has to be something that counterbalances something that's above 30%. So that's it, debt to income ratio. Why is it important? Because co-ops, A, will deny you, and they don't have to give you a reason. B is that the better your debt to income ratio, in other words, the lower the number, the lower your debt is per month to how much you make, the more likely you're going to be approved, the stronger you look in the co-op's eyes, and as well as the bank's eyes. The bank's going to give you a better rate if you're at 25% as opposed to 35%. So again, an example is if you make $10,000 a month per month before taxes, and then you take, including your new mortgage, the mortgage you're even going to take out on the home you're buying, it has to be $3,000 or below. Your debt has to be $3,000 or below, all of your debt. It's a very complicated situation to explain across the board. That's why I always ask people, fill out, there's something called a REBNY financial statement. REBNY is Real Estate Board of New York. They fill that out. They put in all of their income on the left side. They put in all their debt on the right side. They come with a grand total. Right at the bottom, you divide one into the other. You divide the debt into your income, your monthly income before taxes, and you come up with a percentage. And you could say, well, you know, I can easily escape that by. Not in a co-op. Co-ops, they look at 2 years tax returns. They look at all of your reference letters. They run your credit. They look at your pay stubs, your salary, CPA letter. They have the whole gamut. If one of them doesn't match up, they're like, oh, what's going on here? And then you come in for the interview and they'll question you. Co-ops are really smart. So debt to income ratio is extremely important. This is probably one reason to even use a real estate agent. A good real estate agent knows how to reduce your debt to income ratio. Let's pay down this. Let's move the assets over here so we have more income coming in. You know, there's a way to make your debt to income ratio lower, and it's really important because that's what they look at. They crunch the numbers. You don't know who's on the board. The board could consist of an accountant. Anyway, someone just went banana hammocks across the way. Anyway, if you have any questions, this is day, I think, 5 of my every weekday. I do a video, debt to income ratio, kind of complicated, but it's easy when you talk about it individually per person. So if you have any questions, leave comments, shoot me an email. Favorite social media is definitely Instagram. I'm going to be picking up my phone right now to make sure that I could turn it off. It's great. I know I show it on every video. It's a live view. It's pretty cool. Anyway, give me any questions that you have. Charles Botensten for Botensten Properties International, and I shall be seeing you again tomorrow.